Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
You know, when one company buys another, it's a massive event. But how do you actually account for it all? On the world stage, there are two major frameworks calling the shots, US GAAP and IFRS. Today, we're diving into the global accounting showdown between them when it comes to business mergers, and it really all kicks off with one fundamental difference in their whole philosophy. Okay, so right off the bat, here's the core difference. Think of US GAAP as the rule book. It's super specific, giving you detailed instructions for pretty much any situation you can think of. IFRS, on the other hand, is more like the principles. It gives you a broad framework and then expects you to use your professional judgment to apply it. This one single difference is pretty much the root of everything we're about to get into.
All right, here's the game plan for today. We're going to start by finding the common ground they share. Then, we'll dig right into the key differences, explore why they really matter to the bottom line, and then we'll take a peek at where this is all headed in the future.
Now, you might be thinking these two frameworks are like oil and water, just completely different. But they actually start from a place of, well, surprising agreement. If you look at the main guidance, that's ASC 805 for GAAP and IFRS 3 for IFRS, you'll see they're largely on the same page. Both of them mandate that all business combinations have to be accounted for using what's called the acquisition method. So, on the surface at least, they're playing by the same basic rules. So what is this acquisition method they both agree on? Well, the most crucial part is this. It requires the entire deal to be measured at fair value. That means you look at all the assets, all the liabilities, and any ownership held by outside parties, and you value them at what they're actually worth on the day the deal happens. The goal is to capture a true economic snapshot of the combination. This shared foundation is really key. But as you've probably guessed, that surface-level agreement, it's kind of hiding some really crucial differences. And this is where the two frameworks start to go their separate ways. And yep, it all comes right back to that core philosophy we started with. IFRS leans on professional judgment, the why, while GAAP gives you very specific, detailed rules, the how. This is where it gets really interesting and, frankly, a little complicated. And you see the splits right away. I mean, take the very definition of a business. Under US GAAP, there's a mandatory screen test. If most of the value is tied up in a single asset, it's simply not a business. Full stop. IFRS has the same test, but it's optional. We also see differences in how you measure what outsiders own. That's the non-controlling interest, and how you deal with liabilities that might or might not happen. Each of these little forks in the road can lead to totally different numbers for the exact same deal. Now, this is really fascinating. Let's dig into that non-controlling interest, or NCI, for a second. Just think of it as the slice of the company that the new parent doesn't own. US GAAP is simple. You have to measure NCI at its fair value. No choice. But IFRS gives you a choice, and you can make it on a deal-by-deal basis. You can either use fair value, just like GAAP, or you can measure it based on its slice of the net assets. This choice has some major downstream effects, as we're about to see. And the list of differences just keeps growing. What about mergers between two companies that are already owned by the same parent? Well, US GAAP has specific rules for that. IFRS, it's pretty much silent on the issue, leaving it up to professional judgment. You see a similar split with things like push-down accounting, which is how an acquired company updates its books, and how you handle adjustments after the deal is done. It's that classic theme all over again, specific rules versus broad principles. And these little divergences, they pop up everywhere. Like, what about contract assets? US GAAP actually sends you to a completely different part of the rulebook, the revenue standard. IFRS sticks to its core principle. Just measure it at fair value. This pattern repeats for spin-offs and for other complex situations, like acquiring something called a variable interest entity. Each one of these subtle differences can send ripples through the financial statements, changing the entire picture. Okay, so we've geeked out on the technical differences, but why should anyone who isn't a CPA actually care? Well, because these aren't just academic exercises in a textbook. They have a massive, real-world impact on the bottom line. So, at the end of the day, what does all this accounting theory really mean for the businesses making these huge deals and for the investors and analysts trying to make sense of it all? Oh, the consequences are very, very real. These accounting choices can fundamentally change how a company's financial statements look. They directly affect huge balance sheet numbers like goodwill. That's the extra amount you pay for a company above its physical assets. They can make earnings jump all over the place and can even influence which companies get bought or sold in the first place. Let's make this tangible. Remember that choice IFRS allows for measuring NCI? Here's the impact. Under US GAAP, you always use fair value, which means you record what's called full goodwill. But under IFRS, if a company picks that other option, the proportionate share of net assets, it only records partial goodwill. Think about that. Two companies could do the exact same deal but end up with vastly different amounts of goodwill on their balance sheets, all because of one little accounting policy choice allowed under IFRS.
And just when you think you've finally got a handle on all of this, the rules change. This is definitely not a static field. These standards are constantly evolving.
I mean, just look at what's happening right now. This year alone, the International Board proposed new disclosure rules that could create even more daylight between them and US GAAP. At the same time, the US Board is working on new rules for acquiring those complex entities called VIEs. The key takeaway is the goalposts are always moving.
So what this all boils down to is that the gap between these two frameworks is never fixed. It can widen or it can narrow with every single new amendment that comes out. For any company that operates on the global stage, staying on top of these nuances isn't just good practice, it's absolutely essential.
Which leaves us with one final, big picture question to chew on. As our world becomes more interconnected, as business becomes more and more global, will these two titans of accounting ever truly converge and become one single global standard? You know, that remains one of the great unanswered questions in all of finance.